now. So good morning to everyone. Welcome to the latest instalment of Arlene Close's Trending Treasury webinar series, which looks at topical issues in the world of treasury management, capital finance and financial markets. My name is Nick Keeling. It's nice to see so many people joining. Some names I recognise, some I don't. I'm a client director at Arlene Close and regularly present these webinar sessions. The subject today is Brexit deadline day, really with a focus on the potential outcomes from Brexit deadline or the outcome of the negotiations, and with a focus on equity markets. Now, today is the deadline, so I'm sure none of you are surprised that neither side has reached an agreement. And actually, we're now looking at a deadline towards the end of October into early November. I don't think it's any surprise to anyone who's been following the negotiations. The EU and the UK seem to specialise in deadline day deals. Today, obviously, was a Boris Johnson imposed deadline, so not quite the main deadline. So no doubt we'll be perhaps do a webcast on the 30th or the 31st of December, still talking about the same issue. I'm joined today by Richard Colwell. He is the head of UK equities and portfolio manager at Columbia Threadneedle, and there is his bio on the screen. He's the fund manager for three UK equities funds, the UK Growth and Income Fund, the UK Equity Income Fund, and the UK Equity Alpha Fund. So really, there's no one better placed really to talk about the effects of Brexit and other issues on the UK equity markets. Richard, how are you this morning? Thanks for joining us.
Very good, thank you. Yeah, thanks for the invite.
I guess you weren't surprised by the news either this morning about the extension to the negotiations.
No, as you say, it's you're looking at a late thin deal that you're shooting for. So both sides adopting hardline stance. Keeping us interested right to the wire.
As is always the case, it seems, with these. I think we could do without the interest in some cases. It'd just be nice to be simple, but still. It's probably best to start this subject off with a kind of a brief potted history, just in a few lines of where we've been, probably since Boris's election. So Boris was elected, of course, and there's no doubt that his election with a Conservative majority was helped by the Brexit ticket. No sooner as he'd come in as Prime Minister, he renegotiated the withdrawal deal and got it through at the first attempt. Let's not forget Theresa May tried, I think, 3 times to get that through Parliament, but Boris's majority certainly helped that through. We have withdrawn from the EU. It's difficult. Sometimes it's easy to lose the sight of that, given events since then. But on the 31st of January, we did withdraw from the EU, and we started the transitionary period. And of course, at that point, we also started a trade negotiation with the view of leaving the EU with that trade deal by the 31st of December. Now, I'm sure Richard's got a view on this, but it always looked highly unlikely that in 11 months we were going to negotiate a full trade deal, even though the Bank of England, of course, still has that within their forecasts. But that's where we are. COVID's hit us. Attention completely left Brexit. That was yesterday's news. We had bigger things to worry about, but it was still going on in the background. Interestingly, the UK government decided not to extend the transitionary period. I think that would have found fertile ground with the EU. I think they were quite happy to do that if we'd have requested it. We decided not to. Obviously, perhaps the strategy there was to maintain impotence in the negotiations. And so we're still left with this 31st December deadline for leaving the EU, finishing the transitionary period and becoming a completely separate country. We've also tried to pass legislation to renegotiate the international treaty that is the withdrawal deal, which possibly didn't help in recent negotiations. Boris, of course, set the 15th of October as the deadline to have a deal ready, which we failed to meet. And we've still got no key progress on key points, including fishing rights, state aid, So government support for our industries. And now a new one because of that withdrawal deal renegotiation, enforcement. The EU is very hot at the moment on how do they enforce the international treaty that will be the trade deal if the UK is so ready to go back to Parliament and try and renegotiate those situations. Richard, in terms of where you see the trade deal going, you've already mentioned a thin trade deal. What do we mean by that?
Well, we're basically looking at goods and trying to avoid WTO and tariffs. But in the thornier, more difficult services side of things, I suspect that that would be ongoing negotiations beyond the deadline of this year. So it won't be a clean break, everything sorted onwards and upwards. You're looking at a sort of a bare bones deal that avoids a crash out and avoids issues at ports. Really, I think that's what we're shooting for.
Okay, that's interesting. My thoughts exactly. In terms of your thoughts when you're looking at your portfolios, and Columbia Threadneedle in particular, what kind of probabilities, or if indeed you do, on the prospect of us actually leaving the EU without a deal? Because it seems that those probabilities have simply been growing throughout the last few months.
Yeah, I mean, sort of from my perspective, trying to construct portfolios of UK stocks, we obviously, you've got to operate within a framework of scenarios, but we don't sort of labour the point, try and pouring through all the minutiae of every pronouncement from the politicians or civil servants. Nevertheless, obviously, within our business, like a lot of investment firms, on our risk team and our asset allocation teams, they are doing more scenario work and implications for currencies, etc. So, that we're not ignoring it, we're not hiding under the duvet, but as you say, that it's a moving feast, and you could end up chasing your tail. That there's a whole industry out there where there's a lot of quant-driven money that is put to work based on algorithms which are picking up particular key phrases by politicians or movements in currencies, and where that cascades through. But I suppose a couple of thoughts before I shut up is that I suppose this is not landing from a clear blue sky in the way that the 16 referendum did. So in terms of the market processing and repositioning, because they were caught on the hop, I mean, rest assured, the last 5 years have been relentless doom loop on UK equities. So, things overshoot always. So if we did have a crash out, no deal, straight to WTO, of course, the currency would move lower. And of course, a lot of the most affected economically sensitive stocks would be hit. But, their valuations and their share prices are very beleaguered already. So it's not like we're coming off of a high perch. I think that's important to recognise. And the lament, I guess, is that the way we've kind of decoupled as an equity market compared to the global equity market is this kind of reflection that the sorts of stocks that are most impacted by a bad Brexit outcome or are most disrupted are also the ones who've been most hit by COVID as well. So there's a double discount almost in some respects. So it's quite interesting, but there's a lot of people trying to make hay trading in and out on the nuances, but that's not really what we're trying to do, putting monies to work on behalf of your clients.
Okay, that's useful. You touched on a few points there about the last few years. I think it's probably worth looking at the economic consequences ahead of Brexit, because there's no doubt the UK's economy, as like you say, there seems to be a doom loop. It's inequities, but there's a reason for that, isn't there? It's simply because the economic data has been coming out relatively weaker than it possibly would have done without the Brexit referendum and without this long drawn out process of, oh dear, look at the end of this, that there is no light at the end of the tunnel. So on the screen, hopefully you can all see the first of just three charts. This is to do with business confidence and business investment. A business investment is incredibly important for long-term economic growth. It provides productivity gains. It provides innovation that drives long-term economic growth. And you can see in 2016, ahead of the referendum, businesses were, and by the way, business investment is actually on the right-hand axis in a percentage terms on the year before. So business investment was already falling into 2017, and it's been on this downward track. And yes, there was a brief recovery back above zero, perhaps probably due to weak comparators in previous years. But then again, you can see the COVID. So we can't blame COVID on Brexit, but we can certainly blame this very weak position of business investment going forward. And you can see again with confidence has followed that down. So business confidence, because of the uncertainties, perhaps Brexit, perhaps the US-China trade issues as well. Business confidence has fallen, and business investment as a consequence of that has fallen too. So if we can look at the next slide, we can look at consumer confidence. Now, I think it's fair to say that consumer confidence hasn't always followed the Brexit story. As Richard said, not everyone is hanging on the words of what politicians say in terms of all these outcomes. You can certainly see the 2016 effect, very sharp fall in confidence, but it recovered very, very quickly. And you could say that retail sales as well, which is the blue line, held up rather well. But there's been a general downward track, and what we've seen is consumers being somewhat depressed about the future, the economic future, not about their current circumstances, but about the economic future. And Brexit's definitely playing a role there in terms of that kind of outlook. And again, if we move on to the next slide, Richard talked about the decoupling of UK equity markets from global equity markets. And to some extent, that's a reflection of the weakness of UK growth relative to some of our closest competitors, if you want to call those other countries. We've got the UK, US, and EU here since 2015, where we've rebased at 100, and you can see initially following the referendum there was very little change, but ongoing through this process, through the withdrawal agreement process, through the lack of agreement, the defeats for government, the situation where business in particular have had no clear outcome. What's going to happen? Are we going to have a deal? We're going to have a free trade deal. And you can see it has been affecting growth, and the UK has suffered for that. I think the UK economy has suffered that relative to others. And perhaps then when the COVID situation did hit, it hit an economy in a weaker position. And maybe that's part of the reason for our weaker growth since then. So a very quick overview, perhaps, of some points. So, Richard, to come back to you, it would be worth, I think, you've given us a kind of a brief overview of equity markets, but perhaps you can focus on that relative position, as I've done with growth just then. But how's the UK equity markets been affected in relative terms against others, perhaps with a Brexit view on that?
Yeah, thanks. Yeah, I mean, it's sort of without trying to sound like King Canute in front of the waves or whatever. I suppose we've always sort of maintained ever since the referendum that the UK stock market, although it's seen as a barometer and a lightning rod for a sentiment, an attitude towards the UK economy and to some extent our political environment, the reality is that the UK stock market is a very broad church, and that in terms of quoted companies, the profitability that is generated from the UK economy is only about 25%. So I think that's worthy of mention, that we're not landlocked. There's clearly some industries and companies that are dependent, but in general, I think that is a worthy point. So in terms of the decoupling, I think what's interesting is that although your slide 5 shows that sharp decline in relative performance of the UK economy. If you look in year on year, relative to Europe's not exactly been a bundle of laughter and buoyant growth. So it should have been maybe not a score draw, but we should be losing 2-1 or something like that. But if you look at the relative performance of the stock markets, then there has been a more amplified decoupling. So that is important to remember. So I think, obviously there's the current sell-offs going on at the moment, but up until very recently, the US stock market has obviously recovered pretty much all, if not more, of the initial COVID hit, and Europe ex-UK had recovered up about 70% of the March-April sell-off, whereas the UK up until a month ago or so had only got back about 40-odd%. So that's I think one of the slides there. I've got slide 8. Just sort of is quite a good snapshot of on the left-hand side that we came into COVID, as you said, having lagged global markets markedly over the previous 4 years, and yet rather than being relatively insulated because sentiment was already weak and not exactly a lot of hot money was residing in UK stock markets, and yet you can see on the left-hand side of slide 8 that only Russia and Brazil have fared worse up to the end of August. So why is that? Yeah, we can backfill a narrative and say, oh, it's because our government's been pretty chaotic in its dealings with COVID, which is true, but whether it's is it genuine correlation or a bit spurious? But I think it's a lot to, as you said, Nick, it's the anxiety of the amplified impact on an economy that's got uncertainty if we were to get a hard Brexit and the perceptions around that. So that's why sentiment on the right in the red zone, as is that snapshot survey has been like that pretty much every quarter for 5 years. Now I would be half full rather than half empty and say from here, you don't need sunny side up, brilliant, robust a Brexit deal and a vaccine for all to get the UK stock market being perceived more favourably. I think it's the second derivative of less bad stuff, and obviously it's an opportunity cost. Maybe there'll be anxieties over the US or Asia, etc. as well. So to bear that in mind, I think. So that's as I say, that comments earlier, that this is not landing from a clear blue sky, and that never mind trying to work out how much has been discounted already in share prices. More importantly, I guess, is that managements have not, waited for clarity from politicians. They've got on with trying to future-proof their businesses. So, they were ready for a hard Brexit, by this time last year for sure, because going into the Boris election, you didn't know how that was going to land and if it was going to be further paralysis. So I think that should be reassuring, that the banks are all set up for a hard Brexit. They're not got, or fingers crossed, they think that they're resilient and ready for it. And I know how that sentiment and the degree to which you've seen monies flow out of UK stock markets on slide 9, just gives you a flavour of what the implications of that have been on valuations. Not that there's any hang your hat on, but a variation of price to earnings, yield, etc. shows how extreme valuations have got, even stripping out some of the big high profile industries that have been most impacted through COVID, so on the right hand side as well. So it's what's in the price really, rather, and in stock markets, it's the opposite of what it should be, in that opinions follow share prices rather than the other way around. So people have got more and more aggressively angry and frustrated with Brexit and all the rest of it, as the share, and now the narrative is, oh, why do we have anything in UK equities? It's rubbish. There's no good companies, or it's all it's emotional. It's
that doom loop you're just about to say, actually, weren't you? You were referring to earlier. So that's interesting. So your point really is the point here then for UK equities, that actually any certainty is better than the uncertainty. So
markets don't like uncertainty, and if you're sat there as a global asset allocator in Singapore or wherever, that you're going, Brexit, what is this? I don't understand that. That's just nonsense. Surely, don't rock the boat. Status quo might not have been perfect, but just carry on. And in a global index, the UK is now less than 5%. So if you're a global investor, you've just parked it and you've just gone, I don't need to worry about it, so I'll ignore it. And then and on top of that, what's worse is that if you're a big hedge fund globally, then you've got to keep a balance in your long positions where you've got most enthusiasm about, and obviously the crowded trade has been US megatech, so everybody's in that trade. They're all long US megatech, and to keep a balance on their net position, they have to keep increasing their shorts, the thing they hate the most, and obviously it's UK. So every day of every week of every month, UK shares are being sold, because the machines are just, and sort of these basket trades that wash through the market all the time. So it's very technical. So could you see a snap back in that? That could happen very quickly, just because, as you say, there's a removal of some of that uncertainty. Okay, we can calibrate it. We know where we are. So who knows if it were to be a crash out WTO, so sterling dollar goes to, I don't know, 115, 120, where it did initially after the referendum. So you can recalibrate that. Bank of England will come in, the way it's narrative on negative rates, it's warming the market up to sort of say, not only will we do a bit of QE in November, if the most disruptive scenario comes through, they won't sit on their hands. They'll be prepared to do something to try and mitigate that. So I think that's important.
So that's an interesting point, actually. Do you think then, just looking at monetary policy, do you think that more monetary policy by the Bank of England, whether more QE or negative rates, which in the past has been good for equities generally, despite what we see, on the screen, do you think that will have a continued positive effect?
Well, I'm in the camp that says negative rates are not a good thing, that you are crossing a threshold there.
Yeah, I'm with you there. Yeah.
And I think, despite your chart 5, I mean, I do think the history of continental Europe economic growth, which has been moribund for over a decade, and this is now their third recession since, including the financial crisis and then obviously Greek crisis. And the problem is that negative rates, which we've seen for a fair time now in Europe, has not kick-started economic growth. So it's not the panacea, far from it, I would say. And there's distortions of behaviour, both savers, investors, etc., etc. But the other aspect of what you're saying, which has driven this very sharp recovery in global equity markets since the COVID shock, led by the Fed, has indeed been shock and awe, huge stimulus of whatever it is, 3 trillion from the Fed alone. So there, I think it's right to have at the back of your mind there is this sort of moral hazard issue that where has all that money gone? Well, it's ironically not necessarily gone to the most in need, as it were, and so there's quite a lot of speculation and a lot of money that's poured into certain parts of the market, particularly in the US, chasing growth and vision, good stories, so there's unintended consequences. It might have been a necessary extreme measures to try and get the economy globally on a more even keel, alongside obviously the big fiscal intervention by governments, but not I think there is a debate as to whether should we always reach in for more money printing. Is that the only solution in the face of every bear market or crisis? And not necessarily, because the banks aren't in this position they were in '08, so arguably you wouldn't have seen quite as big a shock to money supply this time round. So you're right. It's sort of the idea that the Fed has got your back and equity markets can continue to decouple from the reality of very tough economic backgrounds, rising unemployment, etc. At some point, that elastic gets too stretched, I think.
Okay, that's an interesting view. It's generally the view, as I said, that more money into the system, especially with rates where they are, that it's only going to go to one place, and that's really long bonds, I suppose, to a certain extent, and equities. So that's an interesting point of view, given that we do seem to be on the verge of more QE. I think we agree with you in terms of the negative rates forecast, as our clients know, and the listeners will know, is 0.1, so basically stable with QE as the tool. But like you say, we can't argue with the fact that they seem to be preparing the ground. There's definitely downside risks for that. So in terms of going forward, I think you've basically said that, well, we've discussed that certainty is better than uncertainty, no matter the we've discussed that UK equities seem to be very depressed and really haven't benefited hugely from any bounce back. So the QE that's been put into the system hasn't really affected the UK, and so there could be a revaluation at some point, simply because all the downside seems to be priced in, and perhaps none of the upside. Which is great for it's a nice viewpoint for some of our listeners, especially with the holdings in UK equities that haven't done as well perhaps as the global position. So I guess just focusing on Brexit a bit more, we've talked about kind of negative rates maybe, but in terms of sectors you think are winners and losers, can you touch upon that and maybe the way you have traded those sectors or hold those sectors?
Yeah, I mean, so
Brexit, I mean, sorry.
Yeah, I mean,
not COVID.
the market, I guess, has been quite efficient in diagnosing, the most obvious areas of stress, and has shot those stocks and asked questions later, if you like. So, in a way, if you think back to sort of this time last year, you did have a little bit of a hint as to what could happen, in the sense that from last summer in 19, you did see the areas of the stock market that had been under most pressure because of the whole context of a Theresa May government that didn't have a mandate to negotiate effectively with Brussels, etc. So it had become like consensual that that there was a very high risk of a crash out, sort of no deal, etc. And nobody expected an emphatic majority for a government, etc. So either side of the election last year, you saw a big recovery in stocks that had been under most pressure. So banks, the banks is an interesting one right now because of the previous question, in that they're on a cliff edge, really, that they're very beaten up because obviously we all know bad debt provisions are coming down the tracks. They've had to remove their dividends because, that in a way they're beholden to the government and their regulator. We all know, see Japan, that a negative interest rate environment is not good for the endowment, effects and net interest income for banks. So you've got that risk. But if we were to get a Brexit deal and the passporting gets resolved, then that bare point that has plagued that part of the market would be removed. So all things being equal, you would have quite a decent squeeze recovery in banks, I would suggest. Likewise, when I say the profit pool for quoted companies in the UK is broader than just the UK, but obviously the outside of the FTSE 100, the mid cap area, the small cap area, there by definition there's more domestic orientated companies in that part of the market. So all things being equal, like Q4 last year, that part of the market that's been under pressure because of the COVID disruption as well and the Brexit uncertainties would see another recovery. So if you got a deal, you'd expect banks and more economically sensitive domestic companies to do quite well out of that. And in any kind of rotation in markets, that the other side of the trade would be that more resilient businesses that have navigated COVID and are not as beholden to a Brexit deal one way or t'other, where a lot of money might be hiding even within the UK, that they might see some money come out of them. Now, whether that's pharmaceuticals or mining, etc. Last year, ironically, there was a lot of money hiding in oil, thinking that was a safe haven relative to Brexit worries. Yeah. So I think it's quite interesting. We debate with our internal risk team, and they try and do scenarios of, well, what if we get a crash out, no deal? How will that impact your portfolios, etc.? And unfortunately, the only playbook they kind of go back to is to see what the share price movements were after that referendum result in 2016. But as I said earlier, that landed from a clear blue sky when a lot of these domestic companies were, quite well regarded, highly rated, expectation of a long cycle economic growth, etc. So there's a lot of money that was flushed out, and the share prices were coming off a quite higher level. So now they're down here 5 years on, will they take another leg down? I mean, markets, valuations seem to have taken a bit of a sidetrack to sentiment at the moment. So yes, they might go down some more, but they shouldn't go down anywhere near what they did in 2016. Yeah. So it should be less amplified on the downside, but on the upside, if there is a deal and people feel, all right, we know where we are, that uncertainty's been removed, then all things being equal, that kind of rally stroke rotation that you had in the markets either side of the Boris election could be revisited, I think.
Okay, thanks, Richard. We've gone a little bit over time, but I do want to cover one last point, and that's about dividend income from equity markets. We've seen dividends being lower, obviously, because of COVID. Just to get your view fairly briefly on where we see that, how we see that developing over time.
Yeah, I mean, I didn't realise that I was quoting a baddie company data, so we won't talk about a chart that I put in there.
We've removed that, actually.
What I don't want people thinking is that the UK is only any good for dividends because it's got low growth industries exposure, etc., and it lives or dies by a dividend. And because the dividends are being hit hard because of COVID, then why would you need to bother with UK equity? I think that's too one-dimensional and wrong. There are some really good businesses with lots of growth prospects, and there's this massive value arbitrage that companies kind of minding their own business but happen to be quoted in the UK versus their peers that they compete with, quoted in the US or Europe, that command a much higher valuation. So there's a disconnect between the intrinsic valuation of companies in the UK and their share prices, that double discount that I mentioned earlier. But in terms of dividends, I think it's a good capital discipline that the culture of UK quoted companies is that, alongside reinvesting money back into their own business to ensure there is future growth and they can compete, I think it's good that money does get passed back to shareholders, because that's the almost the contract. It's like it's the rent payment for us on your behalf, providing capital to companies to grow and fund themselves. So, but dividends are pro-cyclical. So at the end of each cycle, when profits get hit because of a fall in GDP, dividends reflect that. So obviously, after the financial crisis, dividends fell across the UK market by a third in short order. This time round, because literally the music stopped overnight, not over a matter of months, the hit is harder and more concentrated. So rather than over a few years, it's literally in a 6-month period. We'll have endured probably what will amount to about a 40% cut in dividends to the UK market this year. Nevertheless, because of the cheapness, the valuation of UK markets, despite that quantum of hit in dividends, we're still on a forward yield of about 3.5 at the market level. So relative to a world of negative rates, that's still a useful income for investors, I would suggest. And also, you know, the hit has happened. And it's been priced in. So from here, you know, the rebuild will happen with a lag. You know, they won't recover as quickly as profits grow.
Yeah.
So, I mean, you know, earnings, profits will probably get back to 2019 level probably by about 22. And therefore dividends won't get back to the 19 level until probably 23, possibly 24. But so you've gonna, you know, we will enjoy a gradual recovery in dividend growth off of a very low valuation, which has already got a decent yield. And dividends needed to go because, you know, we're all in it together, and it's about preserving as much muscle in businesses so they can swim to the other side of the shore, coming out of this sort of stop-start hibernation. And that, you know, so we're fighting to preserve as many jobs as we can, and shareholders want to take part in that. So it's about making sure businesses have enough liquidity. So it's right that dividends were removed, but as I say, it's part of the contract, and it's not a bonus. It's not an optional. You know, businesses that are able, having repaid, you know, government support, to get back on the dividend paying, then that is a good signal, and that will help their valuations recover.
Okay. Brilliant. Well, thanks for that, Richard. I found that really interesting. I hope our listeners found it really interesting as well. Please leave any questions that you want, and we'll try and get back to you on those. Otherwise, I hope you enjoyed the talk. Thanks to Richard again for a very interesting chat. And tune in to next week's live webcast, which is all about swaps and swap markets and interest in swaps with Mark Swallow and David Green. Okay, thank you very much once again.
Thank you. Cheers.
Thanks, Richard.
Take care.